Perspectives 2020. Welcome the future.
Buenos días, bienvenidos a este encuentro.
Good morning and welcome to this Fidelity Perspectives seminar. And as usual, we'll be speaking about the environment for investment decisions this year. A year which has begun with that reminder of the conflict between Iran and the US, which is not new, but it is a warning in the sense that geopolitical tensions that had not been so visible in the last few years might become all too visible this year. But before I speak about 2020, I'd like to make a couple of comments about 2019, which has been a surprising year for many, certainly at Fidelity. No one, including analysts and asset managers, expected such a brilliant 2019 for the markets, with 30% rises in the US, which have mobilized global equity markets, yields of 12% in Spain, 28% in Italy, 18% in Japan, 25% in China, and also in fixed income, excellent yields. For example, that 6% of European investment grade debt, which in the case of the US was 14%. And we were surprised that neither the global economic slowdown, which has impacted neighboring large economies like Germany's or Italy, nor growing protectionism all over the world, not just in the US and China, nor the weakness of business investment in the US, so-called gross capital creation, nor the protests from Paris to Hong Kong have had an impact on a year which has seemed to ignore all social, economic, and political tensions. Ultimately, valuations of bonds and equity have looked much more at the good news, and there were good news this year, including the increase in business profit outlook, strength of consumption in the US, as well as, of course, continuing low interest rates below what we all were expecting for the year. Because I think ultimately monetary policy has been the biggest driver of trends in 2019. 12 months ago, every analyst thought that interest rates would rise in the US, and yet interest rates have been brought down 3 times, and that has really driven the equity markets all over the world. And the second comment has to do with the flow of funds, because markets have been very bullish in the year, and nevertheless, funding flows have not really gone to the equity markets. They have been the ones that have benefited the loss from these flows. We have seen outflows from equity markets, particularly strong in the first half of the year, up to the levels of 2011 or 12, during the Arab Spring and the tsunami and all the question marks about the European Monetary Union. Reimbursements that have probably had a lot to do with that feeling that this rallying was driven by low interest rates and by liquidity injections from monetary authorities. But in any case, we're starting 2020 wondering how long the markets can continue to rally and volatility stay relatively low, as it has done really over the last decade. And so there's quite a bit of consensus in the sense that the effectiveness of these monetary policies has probably come to an end, and that we'll probably see more governments that will resort to increasing expenditure as a way to drive growth in their economies. And these are some of the topics that we'll be covering this morning. And to do so, we have 3 members of Fidelity's investment team. The first presentation will be by Andrew McCaffery, who is the global CIO Asset Management, Fidelity, and he's going to talk about the 4 key elements to consider this year and where we see the biggest opportunities. He has 30 years experience in the sector, and before he joined Fidelity, he worked at Lucas Capital, UBS, and Nest Capital. And we'll also hear from Dan Roberts, who I think is known to most of you since he is the manager of the Fidelity Global Dividend Fund, and he'll talk about how to invest in companies with good dividends in the current context with high valuations. And he's also going to briefly explain his fund. He joined Fidelity 8 years ago now, and he manages, combining mandates and funds, about 10 billion, of which 8 are in the Fidelity Global Dividend Fund. And the third speaker will be Jon Guinness, who is a specialist in technology and telecommunications and co-manager of the Fidelity Global Communications Fund, which has recently been launched. And in his presentation, we will see how some of those science fiction concepts we saw in films not too long ago are now a reality thanks to 5G and its potential. And Jon Guinness is part of Fidelity's investment team since 15 years ago. And like Andrew and Dan, he is British, and also an EU citizen, although, of course, we don't know how long that's going to last. At the end of Jon's presentation, we'll have time for Q&A. That will be moderated by Domingo Barroso, who is sales manager for Fidelity in Spain and Portugal. And you'll be able to send your questions for that Q&A to the email address you can see on the screen. And you can send your questions at any time during the presentations, and your questions will be answered during the Q&A session, which will take between 10 to 15 minutes. And with that, I'll just thank you for being here, and I'm going to give Andrew the floor. Andrew.
So, buenos dias. Unfortunately, that's all my Spanish for today. But I would like to thank my Spanish colleagues to start, because those photos were very flattering, especially of me, but I've also, my colleagues smiled as well. So, but to get underway for today, I'm going to touch on what are basically where we think the outlook is, but trying to just touch on a very brief profile of some of the key elements that we think will influence how the year will develop, try to give some thoughts around how to think about that and signals to look for, and then just to finish off, actually give you a sense of where we are currently and the fact that how we're thinking of trying to navigate from looking at an asset allocation perspective. So I'm going to start with, it says what lies ahead, and to a degree it's looking at where we are today, and then moving on to talking about some of those key influences, and then finishing on what we see as some of the risks and opportunities that we have around the global environment. So in terms of these charts, we have basically on the left-hand side, we have what we have as a proprietary leading indicator that we've developed. Look at how activity is developing across the global economy. As you can see, what is really interesting, I think, is that post-financial crisis and that sharp drop and the sharp recovery is actually that the environment has been remarkably subdued. In fact, actually being more constrained through time. As we look into 2020, then we have seen that the environment is actually looking slightly more constructive from the dip that we'd seen earlier in 2019. And that's reflected in the cycle tracker on the right-hand side, where you can see that we've moved into this environment. We look at it in quadrants, but into a positive environment of growth and an improving profile. That really started to come through earlier in 2019. We saw the stimulus, which I'll come back to in a second, from central banks that really influenced activities. We went into Q4 of 2019. And if you were to project where this is now, as we keep this running month on month, it is starting to just move down. So if you think about that right-hand chart, it's just starting to move towards that sort of center boundary. So some of the momentum is being lost, but it's still in a constructive position. Now, I think that when you consider looking forward, we have to just quickly take stock of where we've been. And obviously this time last year, it would have been very interesting as we were looking back on what had been a very challenging Q4 to 2018. As you're all aware that markets pretty much across the board had performed very poorly. However, obviously we've just had an incredible year that has seen performance across all risk assets in different forms. So a very positive profile to work with coming into 2020. I would just point out from here, though, that we have, although the positive performance across different asset classes, that you've seen quite subdued profile when you think about the euro. And actually, that's one of the things that will be interesting during 2020, is how we see, especially for the dollar as well as for the euro, what is the direction? Do we break out of these very tight ranges? And what does that mean as an influence? So moving on, I'd like to look at some of the drivers. These are just to give a profile of the things that I'd like to just move into in a little bit more detail. And first of those is to move to global growth. If we look at the profile as it stands today, and this is giving a picture of a global profile and a specific for the US, looking to the dark blue line for the US. And what I think, again, is that you can see is this profile in recent years where, again, it's relatively subdued at a global level, that growth has been generally positive, but not in any significant way. And again, relatively constrained. It dipped below as we came into 2019 and now definitely starting to show signs of improvement. But if you look at the US, it's been progressively, post the US tax cuts and the Trump policy of 2017, starting to move down. And the environment in the US, actually, that we tend to think as being quite dynamic and being very much a leader, is actually starting to be into more of a down cycle, and actually is in a more challenging environment as we enter 2020, and really only supported by the very strong stimulus that we saw occur in the United States from the Federal Reserve through Q3 of last year. That's important because when we look at some of the drivers of this, and these two charts are really looking into the larger part of the corporate environment within the US, that we see on the left-hand side basically is the CEO confidence surveys. And this reflects within the S&P 500 companies, what is the confidence of the CEOs, CFOs that are surveyed for this. And generally you've seen this decline, and this is trying to capture a longer period, just to show how this moves through time. But what's very interesting is that it has been declining for some time, and even now, with the fact that we've seen a slight improvement in the environment, that we're not seeing that sense of future optimism really pick up. One would have expected with the US-China phase one deal that there could have been some signs of stabilization, and there have been. But the general problem is that we've seen some of the supply chain impacts, some of the deterioration in the expectations of returns on investment declining, where they have tended to feel less confident about how they can invest. And sort of look at the environment looking forward, which will bring us back into a second around the US political position as we go into and through an election year, impacting that thinking. Why this is important is that it's one of the risks as well as the insights to the environment. It tends to be a leading indicator. So there's one thing maybe just to remember as you look forward as the year progresses, is that CEO confidence surveys, also the NFIB, the small businesses surveys, are very important because they have now started to stall, and they have been an important part of driving employment and wage growth in the US. And then consumer confidence, which remains very high. Part of those indices are made up from stock market prices. Part of it's from wages and part from real activity. So that tends to be a lagging indicator. But it's worth keeping an eye on these things, because unless we see some stabilization and uptick, and which I'll argue in a second may actually be quite difficult during this election year, then it could be something that says the US is going to have a more challenging growth environment. Just switching on to the monetary conditions that I touched on a minute ago, that we saw this incredible level of stimulus. It wasn't just in Q3 of last year when we saw the Fed move in, It was throughout the year. And the reason we've put up on the right-hand side a number of the developing economies is that we haven't seen such combined stimulus since 2009. So it's really quite a significant year in terms of that willingness of central banks to intervene and to improve financial conditions. But it really is quite a standout period. But it means they've used up quite a lot of their firepower to support, again, economies that were struggling to generate growth. But I think it is important that when you look around the world, and when I move from the US and look into elsewhere in the world, that this is something that actually has improved financial conditions globally, but it's and likely to have more impact outside of the US in terms of what it can generate in growth and the opportunity for performance across some of financial markets. I just want to touch on the dollar. I mentioned about this very sort of constrained profile. When you look at the larger developed currencies and relationships. But we have seen some significant movements. And if you look at this profile and some of the countries, obviously, in a reference to the UK, that we've felt the effect of sterling at times, but it is now into a very undervalued profile. While you saw that sort of support on any relatively good news in Q4 of last year. But what's important about here is it means that the dollar is now at a point where we think is somewhat overvalued. But it also gives scope where you've seen this level of stimulus from some of the currency depreciation that can come through into these individual economies. And so some of the developing economies, even some of the other non-EU European currencies, have actually had a level of stimulus come through in 2019. So combine that with the monetary profile, may find that there's actually markets that could find quite a tailwind as we enter 2020 and as we progress through the year. But again, back to my points about the US, the challenge then around that is that you could find that we have this interesting environment where actually the US is having lower growth relative to many of the other economies around the world, especially in the developing economies. But also that there's conditions for the dollar to start to actually see degrees of underperformance. Now, I think part of that is in the context as well, is to remember that the Fed has stimulated, but also that to keep the economy stable is continuing to provide stimulus. But we have a US election this year. And one of the things I think about that is the degree to which the Federal Reserve has scope to move as the year progresses, but also the uncertainty, going back to that CEO confidence and thinking about how people will react as we see the Democratic candidate put into the final position some point in Q2 of this year, what that means in terms of the markets thinking about policy, what could happen to policy and implications for the economy. So I think that as we come into Q1, there's actually a number of things that the markets will start to now think about in the year, which actually will introduce some levels of uncertainty and could actually be something that starts to mean that the dollar's general outperformance that we've seen for a few years starts to dissipate and maybe even weaken, but especially against some of these developing market currencies. And the last one is on volatility. It's something put up the last 3 years that if you look at 2019, 2017, we all know that actually how subdued it was. We had some spikes during the 2019 environment, but nothing like 2018. I think as we look forward and think about the election environment in the US, the general geopolitical profile, the fact that the Chinese announced last night that they would not remove tariffs until it's post the election. So almost a little bit of an optionality that they're taking as well. That there's likely that the smooth profile of volatility we saw in 2017 is unlikely to be replicated. 2018, most probably some of those sharp moves seem very high from the position we sit today, but likely that we shouldn't rule out that we may have bouts through the year that will be testing for markets to have to build into their expectations. So maybe that profile of 2019 actually gives a good insight that we start and we have these periods where at least there's some adjustments, some correction as we see how much the stimulus is working, how much that support to growth, and how much the political events are or aren't actually starting to impact onto the market expectation. So again, they're thinking more that at times, tactically, one would be thinking about having degrees of hedging and long volatility as we go through the year. And actually, when you look at where prices are today, when you look at the way that some of these events will start to be part of market discussion in the next few weeks and months, it's actually quite cheap to start thinking about that as part of a tactical protection now. So I just want to touch more on some of the individual elements and to pull this together in terms of finally what our views are as we enter 2020 in terms of actual asset allocation. And I just wanted to touch on a couple of things that because of the relevance as we start the new year and what's happened. One is the very short-term profile on the left-hand side for what happened with the recent events coming into the year. Obviously, the Iranian and US tensions that occurred post the killing of General Soleimani. And again, that the oil price relatively subdued, but I don't think that one should lose sight that actually moving into higher levels is still going to have an important impact as we go through the year. And even though we don't see at this stage that inflation is a particular concern, what these two charts are showing is that some of the friction into supply chains through tariffs and through the movement that's had to occur already is going to stay there. Despite the phase one deal and stopping the worst that could happen at this stage, some of the damage has already been done. The other part in the oil price, most probably getting much above $70, we'll start to see that as a rate of change impact. But actually, if any of you follow the CRB Rind Index, it's worth just having a look at that, because that is something that is about industrial input prices. And that has risen quite sharply over the last couple of months. So I suppose the challenge here and looking forward is that even though we don't see real dynamics for inflation becoming entrenched, the rate of change in some of the inflation numbers actually could see a risk of picking up in the next few months. And so again, it's that market sentiment where we are and thinking forward that actually it's something not to lose sight of. I don't think it's something that one goes out and is actively making investment decisions on, other than the fact that when you look at inflation protection securities, so looking at TIPS in the US and the inflation securities in Europe and elsewhere in the world, they're actually very good value at their current levels, and if there were any signs of uptick, they would be performing very well. So it's something maybe you think at a portfolio level of including, because of where pricing is, where there may be small risk of race change would change some of the sentiment, because consensus doesn't expect any signs of inflation. But looking to draw this together, that I think basically you have this profile where, as I said, stabilization generally, that and that improvement through 2019 still holding as we come to 2020. Where it will manifest itself, though, is more likely to be outside of the US. And I think that's important. You could see a lower growth profile in the US, more challenging environment around what can the Fed do, what are the election expectations as they develop. If it's Bernie Sanders and not Joe Biden, how does that influence the sort of thought process? And that's why I think, coming back to it, there's better opportunities to look outside of the US this year. And I know it's a big call, but to say that we think that the US is going to underperform and the dollar may actually underperform relative to especially some of the Asian currencies in developing markets, could mean that there's a meaningful degree of potential for outperformance by finally being at or underweight the US. I think the geopolitical position is not going to go away. It most probably goes through, as we see in a moment, the sort of phases of being ignited and then calming. But I think that the reality is that you will see, as we go through the year, more of the focus towards to the US, and what does that mean in terms of, is it Mr. Trump and his approach, or a new profile? The tailwinds, as I mentioned, I think really start to be seen when you look to China, to Asia, to some of the developing markets. It may even be that, again, that some of the relative opportunities sit, looking to parts of Europe relative to the US. And I'll come back, touch on that in second exposures. And then finally, I think that it's just to draw us together is that the risk of this whole profile around the US, that their opportunity for doing much on the fiscal front, maybe even on the monetary front, is actually going to be limited relative to other countries as the year progresses. So I'm not going to cover everything in here, but I think that some of the aspects that it means that could play out is that if you think about the US as being this leader, and obviously a lot of that has been driven by the growth profile. And we tend to think that that may be reaching a point where you do want to really think that not just US and move into underweight there, but actually thinking about growth versus value and quality. And Dan and Jon will talk more about some of the themes around quality of income and around looking through the technology outlook as well. But we tend to feel some of this sort of pricing is now at the level where you could think about rotation from growth into value. And part of that comes from that if the US is going to start to move into a phase of challenge and underperformance, then you want to start looking to other countries, and that actually that's going to produce a value trade that actually starts to get a little bit more traction. Again, quite a big call when we've seen a trend that has just been one way for so many years, but we feel that's starting to develop. In fixed income, I think the key part there is that we really would recommend that, and this is something not looking to the next year, is the next 10 years, that China is going to be a bigger part of benchmark indices. It's going to be a bigger benchmark in terms of setting of rates and influence in Asia as a whole. And it's something that actually should be looked at now and considered as a key part of portfolios, both in terms of opportunity, but its importance as it develops. In terms of specific opportunities, Asian high yield, Asia markets, that local currency exposure I mentioned relative to dollar and to euro, but also the fact that yield spreads can still compress further. I think just on the last thing that the alternatives, it's a very catch-all profile. But if you break out and think about real assets, there's still opportunities for high quality of income. Prices are very high. We are potentially reaching a latter stage of the cycle. But quality of income, looking to mid-market environment, we see very attractive. In terms of the private capital, private debt, and the opportunities there for high quality, slightly higher yield income is still attractive. And again, thinking about volatility, some of the strategies that allow you to be able to get long of volatility in different ways, could be attractive. And just to conclude, this is how we run our tactical asset allocation. It's a very short-term view. So this really is our sort of 3-month view. If I'm honest, that if I were to come back in 2 months, it might look quite different based on what I've said. But in effect, we are taking some of our risks from we don't really see that developed market in fixed income can produce a great deal. We think Europe is challenging to produce returns, and so still looking to be slightly underweight. But use that in balance where you can to look to, as I said, China to Asia especially. In terms of the regional, as you see that we're slightly underweight the US, we expect to go more underweight. We've used that partly to fund looking towards Asia as our preference. But in reality, you can look, depending on your bias, that somewhere like Japan, huge value play. The problem is it has been for a long time, but that you may have unique conditions that start to make it more attractive. But the reality is that the larger profile is this move of moving away from the US, looking most probably to be slightly still risk on, but actually thinking about going neutral. And then our biggest challenge this quarter is actually, do we think about doing more hedging to actually go for a period of potential for some level of correction at a more broad level. So I will stop there, and I'm sure there'll be questions later, but thank you very much for your attention.
Good morning, everyone. Thank you very much for your time today. It's much appreciated. Thank you for Sebastian for the introduction 25 minutes ago. And for anyone who's invested in the strategy in the audience, or indeed has their clients invested in the strategy, let me take this opportunity to say thank you very much for your support. That's certainly not something that I take for granted. So, like Andrew, I have 25 minutes with you today. What I want to cover in that 25 minutes, I just want to spend 1 minute or so, no longer, I promise, but talking about our approach. I don't want to spend too much time there, but I think it's important to go over what we're trying to achieve with this strategy and the key kind of product objectives to set the scene, if you will, for what goes afterwards, to create a framework, if you will, for the rest of the presentation. The bulk of the presentation, I want to talk on market observations. Now, those of you who've heard me present before will know I'm not a top-down investor, so I don't spend any time of my typical day thinking about whether GDP expectations will be beaten, or whether interest rates will go up or down, or whether commodity prices, or which direction commodity prices will move. That's not the kind of thing I think about. Instead, we're looking at individual stocks, potential individual investments, reading annual reports and accounts and so on. Doesn't sound very interesting, but thankfully, I find it quite interesting. But what that does allow me to do is to share with you some observations on the broader market, but focused on things like valuations, balance sheets, levels of corporate profitability. I can share with you some regional observations as well, but driven very much from the bottom up. So that's what I'll do in that section. And then we'll go on to look at fund positioning, and hopefully that will make sense given what's come before. So that's how the presentation is laid out. So I said I'd be very quick on this, the approach. How do I describe the strategy? It's an unconstrained portfolio aiming to deliver a dividend-based total return with an emphasis on capital preservation. So 3 key product features that I'd like you to take away today. First of all, the unconstrained nature of what we do. Now, the way I'd like you to think about this is essentially we construct the portfolio from a blank sheet of paper. So I don't sit at my desk and say, should I be underweight the US or should I be overweight financials? That is categorically not how we approach the problem. It's a blank sheet of paper. It's a best ideas portfolio constructed from the bottom up without reference to a benchmark at all. And the upshot is that if you look at the fund and compare it to a benchmark or an index, it will look and indeed behave very differently to that benchmark. And it's an important point, clearly, when you can buy ETFs and index trackers for 7 basis points or whatever. It's an important point. It's key that we're offering our clients this kind of outcome. So active share is high. It's up at 92%. Turnover is low, 20-25%. What I'm saying there essentially is we're taking some high conviction views, and we tend to hold those views for the longer term, and we think that will give us the best chance of success ultimately over the long term. Now, the dividend, in terms of the dividend, I use this phrase dividend-based total return. What do I mean by that? Well, the clue is in the name of the strategy, the Fidelity Global Dividend Fund. Clearly, it's an important part of the total return I'm looking to deliver. But I use that expression to get across the point that it must not come at the expense of capital. The income must not come at the expense of capital. I think the most common mistake that I've seen dividend investors make over the 15, 20 years that I've been running income strategies is to allocate capital indiscriminately to the highest yielding parts of the market. You know, you fall prey to that siren call of a yield which looks like 7-8%, and you think that's too good to be true. Well, normally it is too good to be true, and you end up suffering a dividend cut, 18 months, 2 years down the line, and with that comes capital loss as well. That's the kind of outcome we want to avoid. What we're trying to do here is strike the right balance between the yield we feel we can offer you or your clients, but without compromising on the quality of dividends which underpin that yield. And at the moment, that means a yield of about 3% and a distribution which has grown consistently at about 4 or 5% over the 8 years since we've launched the product. And then on capital preservation, this is one of the key selling points I know for a lot of investors in the fund. Suffice to say, I take a very conservative attitude to managing risk within the strategy. And referencing again that unconstrained approach, the way I think about risk, it's not about a tracking error, deviation from benchmark. I think even volatility, quite frankly, as a measure of risk, has its flaws. The way I think about risk is hopefully, as your clients think about risk, I ask myself the question, what is the potential to lose money in an investment, to suffer permanent loss of capital? And how can I avoid that kind of outcome through the kinds of companies we invest in, the valuation discipline we have, and the way we put the portfolio together? A lot of people ask me, why that focus on capital preservation? Well, I think we'll all agree at the end of the day, we're in the business of compounding our clients' wealth over time. I think Einstein called it the eighth wonder of the world, this power of compounding. And it's a very simple point, but indulge me for a second. You need to appreciate that in a series of compound returns, gains and losses are not equal. So if you go up 50%, fall 50%, or vice versa, you are still quite significantly underwater. So if we can keep losses off the scorecard and then broadly keep up in a rising market environment, then clearly we will do better across the full market cycle, and it will be a less stressful experience for you and your clients as well. Took more than a minute, but I got across the key points, hopefully. Now, market observations. I always like to start on valuations. I think, frankly, it's the most important determinant of future returns, especially if you're thinking over the medium to long term. On the left-hand side here, you see the PE multiple, price to earnings multiple of the US market. And I think there's no getting away from it, really. The market does look quite rich, quite expensive. We've only really ever been more expensive around the time of the tech boom. 15, 20 years ago. And if you look at other metrics like market cap to GDP or price to sales, cross-cycle metrics, as I would call them, we're just as expensive as we were back then. So I don't think there's any getting away from that. But on a relative basis, I would say, I mentioned I'm still delivering through this strategy a 3% yield, which is growing ahead of inflation. I think relative to other asset classes, the attractions are still pretty obvious. And on the right-hand side, you can see the influence of interest rates over the last couple of years, 2018 and 2019, two very contrasting years. The total return is shown for each of those years at the bottom of those blocks, but you can see the key driver of returns in each of those years. 2018, when the Fed was raising interest rates, we were at the end of a tightening cycle. Huge valuation compression within the market, outweighing the EPS growth. In fact, it was one of the best years for earnings growth, 2018, for a long time, and we actually delivered a negative total return. And then last year, as the Fed took a 180-degree turn, the market reacted to that, and we bumped back up again. All of the total return you saw last year pretty much came in the form of that valuation change. Looking forward from here, I don't expect as much excitement, quite frankly, over 2020. More interesting than the high-level aggregate valuations for me are what's going on beneath the surface. And this is quite a complicated slide, so allow me to explain what's going on for a second. Across the bottom of this slide, we've got the PE multiples, PE buckets. So just think very cheap here on the left-hand side, very expensive on the right-hand side. Now, what I've done here is take the ACWI, the All Country World Index, which is over 2,500 stocks, so it's a statistically significant sample size. What you would expect to see is really a normal distribution of valuations around the market multiple. The market multiple is about 18. That dotted line shows you a normal distribution. Now, the dark blue bars show you the actual distribution of valuations across the market at the moment, and you can see very different from that normal distribution that I mentioned. It's a very flat distribution, and this is because within the equity market at the moment, it feels as though the winners and the losers have kind of been declared. So on the right-hand side here, you can see in those two right-hand buckets, 24 to 30 and 30 plus, roughly 20% of the market sit there. Now, these are the stocks that everybody wants to own, frankly, no matter what the price. And the stocks, it'll be the Microsofts of the world, the Visas, the Amazons, those kind of glory stocks, which have done very well over the last few years, traded on very high valuations. But operationally, they're in a sweet spot. They're providing a lot of growth when not much of the rest of the market is. So you can understand why they're there. But very consensual positioning, I would argue. And then on the other end of the spectrum, roughly 20% again of the market trading on single-digit PE multiples. So these are the stocks that nobody wants to own, no matter how cheap they look. And it can be tobacco, maybe commodities, financials, autos, businesses which are facing structural challenges or maybe very cyclical or a lot of gearing on their balance sheet. So that's the way the market's positioned. Now, the reason for this slide is to show you as well how we are positioned against that. The light blue bars show you how my fund is currently positioned, and you can see two things. First of all, we have a valuation skew. So I touched on a valuation discipline earlier on. It's very important to us. So the fund does trade at a discount to the overall market. But the really important point of this slide, and I've taken a long time to get to this point, but it's really the reason for the slide, is to show that we are largely absent from both of those tails. So our valuation discipline will keep us out of the right-hand side. Those stocks are too rich for our blood. And on the left-hand side, our quality discipline, if you will keep us out of some of those value traps. So it's very much a core strategy, and we're operating in that middle ground. It's a middle ground which has been hollowed out, but that's where we tend to be positioned. Moving from valuations to earnings and the potential for earnings growth, this is where I have actually more concern on a forward-looking basis, just because if you look at where corporate profitability is, we're already way through prior peaks. So on the left-hand side here, we show profit margins for the US and Europe, and you can see historically, this is a series which has been quite reliably mean reverting, but over the last few years, we've gone way through prior peaks. Some of that's been due to Trump's tax cuts and so on, low interest rates, but no real wage growth as well has helped corporate profitability. The problem I have is, as we look forward to here, is just asking the question: how much better can it get? And when you think about the kind of shopping list that I put down there of potential headwinds to margins, whether it's tariffs, whether it's taxes, the Amazon effect, if you will, of disruptive pricing, which tends to destroy profitability for various industries, regulation of big tech, slowing growth just generally. I think most companies need to grow at kind of 3% to offset the cost inflation within their businesses. So all of these are quite significant headwinds to corporate profitability. So consensus is for kind of 9-10% earnings growth over the next 12 months. I would be surprised if we get to those numbers, and I would maybe mid-single digits is maybe the best that we can hope for. Now we can address this in the portfolio. We can focus on companies which have very high earnings persistence, very low earnings variability. That's a bit of an abstract concept, but what I mean by that is companies. Let me give you a few examples. So maybe a professional publisher like Wolters Kluwer that we own. 75% of their revenues are subscription-based. So at the beginning of the year, they've got very good line of sight on their revenues for the year ahead. Maybe low-value consumables with strong brand equity, things like toilet paper and toothpaste. Within industrials, we can buy companies which have a high percentage of aftermarket revenues. So it's not just the selling of the original equipment. They make a lot of profits from servicing that equipment on an ongoing basis. And by focusing on these kind of companies, we can construct a portfolio where earnings is much less, I guess, susceptible to the ebb and flow of broader economic activity. And that's what we're looking to do without having to overpay for that kind of exposure. So we should be relatively well insulated in the outturn that the earnings disappoint. I guess this ties nicely with what Andrew was saying in terms of the outperformance of the US market. Make some regional observations. I think everybody knows it's outperformed. The extent of outperformance is really quite incredible. 100 percentage points of outperformance, essentially since we launched this fund 8 years ago. Huge outperformance. What I would say, and I would say on the left-hand side, I think if you take income out of the MSCI ex-US, we're still not past our 2007 peaks. So really, you could ask what bull market except for in the US. But what I would say about the US market, and you can see there on the right-hand side, is that outperformance of the index has broadly been matched by better earnings. So although a lot of people say the US looks very expensive, I don't think it's egregiously expensive, certainly not relative to other markets, because yes, it's always been a bit more expensive, but that relative premium hasn't really expanded much because of this outperformance on the earnings side. And when I look at individual stocks, certainly, I don't often see a huge difference between valuations. If I compare a Pepsi to a Unilever or an SAP to an Oracle, often the US stock comes out as the cheaper of the two. So a lot of the US, so the outperformance of US earnings, but also the structure of the market, it explains its premium valuation. More tech, more healthcare, more consumer businesses, less banks, less telecoms, less oils than Europe. What I would say about the US is they are the most aggressive at engineering earnings growth, and there are a couple of ways they can do this. I'm sure you've all read about buybacks and the effect they're having on the market. That's what we're showing on the left-hand side here, the extent of buybacks in the US. The dark blue bars show the dollar amount. That's on the left-hand side scale. So 2018, $850 billion of buybacks, and it's a similar number for 2019 as well. I should update the chart. That's roughly 3.5% of the equity market they bought back. Now, there's no real value being created here for me. It's not an improvement in the business necessarily. All it is a financial arbitrage between the cost of debt and the cost of equity. They can raise debt, pay 1% on that debt. They can buy back their equity on a 4 or 5% earnings yield. It creates EPS growth. The chief executive gets paid out on his share options. He's very happy. The shares go up in the short term, at least, and everybody's happy. But it can't go on forever. It's not really creating value, and it can't go on forever. And the reason it can't go on forever is because if you add that 3.5% I mentioned to the 2% dividend yield you get from the US market, that's 5.5% of capital being returned to us as investors. The US companies in aggregate don't generate that amount of cash. So they're filling the gap at the moment by raising debt to do this, to engage in this kind of behavior. That's the reason it cannot go on forever. So it's been a tailwind, but it can't continue indefinitely. And then on the right-hand side, an easier way for them to create earnings growth is just by presenting to us what they call adjusted earnings numbers. Now, if you don't look at annual reports and accounts, you might be surprised here. But what essentially happens is the auditor will come in, look at the accounts, and they say, yes, I agree, you've made $100 of profit. And the auditor walks out the door, and the company turns to us as investors and say, well, the auditor said it was $100. But there are these various cost lines we'd like you to take out. Share-based comp, that's a non-cash expense. You should ignore that. We're going to write off the cost of an acquisition we did 2 years ago, which didn't work out. So you should ignore that as well. We're going to do some restructuring this year. Please take that out of the... And so they make all of these adjustments to come up with a profit number, which, lo and behold, is significantly higher than the one than the auditor presented. And you can see, we're mapping over time here the difference between those two numbers, the audited number, the GAAP number, and the adjusted number. As you would expect, those differences blow out during periods of crisis as restructuring happens and so on. But you can see today it's roughly 20% for the aggregate market. When you see a multiple quoted for the US stock market, it's worth bearing in mind that it's always based off the adjusted number. So the reported number, the PE based off a reported number, would be quite significantly higher. There are a couple of sectors which are most guilty of this kind of behaviour. Tech, with their share-based comp, can be a huge percentage of their profits, which they encourage you to ignore, and pharmaceuticals as well. What a lot of pharmaceutical companies do is buy biotechs as they come up with a promising drug, and then if it doesn't work out, like I said, 2 or 3 years down the line, they write off that expense, but they say it's a one-off, but in reality, it's a part of their business model. So it's just worth bearing in mind, and clearly, when we're looking at individual stocks, it's the kind of thing we're thinking of. Debt. I'm going to have a little moan about debt. Every investor likes to put a chart in their presentation going from the bottom left to the top right. I've got one here. It's debt to GDP. John's got many more in his presentation coming up, believe me. But you can see here, global debt to GDP gone up roughly 50 percentage points since the time of the financial crisis. Not only have we got a lot of debt in the system, it's also the quality of issuance, which for me is a concern, and we're showing that on the bottom right-hand side there. You can see investment grade, how it's broken down by its various ratings. At the time of the financial crisis, roughly 23% of investment grade was BBB, which is the rating just above junk, or high yield, as we now call it. Today, it's almost 50% of investment grade is sitting in that BBB kind of rating category. So not just the overall amount of debt in the system, but the quality of issuance. Now, how that manifests itself in the equity market is interesting. The US, I'm going to have a go at again, they're the most guilty. You can see over the last few years how gearing ratios in the US have spiked up quite considerably. The other side of that coin, emerging markets, gearing ratios tend to be quite low, and across developed markets, actually Japan probably have the most conservative balance sheets. Roughly 50% of companies in Japan have no net debt, have net cash on their balance sheets, so very lowly geared. But geographically, the US stands out as the aggressor here. More importantly for me, because I've I've said to you, it's a defensive strategy. More important for me is where amongst the sectors and industries has this debt been taken on, because it's been taken on in more defensive parts of the market. And I guess this is to be expected in a way. Companies or sectors which were scarred by the last crisis, if you will, still behaving quite conservatively. So you'll look at a Rio Tinto, for example, which will now have net cash on its balance sheet. A lot of financials. I'm not sure how much you can read into capital ratios for financials, but a lot of financials have capital ratios which are a lot stronger now than they were at the time of the financial crisis. So those are still behaving quite well. But these guys, where the bond market's really fallen over itself to offer these guys debt, have really, a lot of them have taken up that offer and bought other companies, bought growth. And you can see a few household names down there: McDonald's, BAT, Molson Coors. The debt ratio 4 or 5 years ago and where it sits today, very, very different place. And if those numbers mean nothing to you, suffice to say, for me, I start to get a bit nervous above 2. Private equity gears up to 5, 6 times, but some of these are not too far away from that. So we just need to bear this in mind. Some of these companies would have been candidates for inclusion in the fund, but the investment case has been compromised for us by the amount of debt that they've taken on. Within the portfolio, we can clearly address that by forensically examining the balance sheet. What we show here, lots of nice colourful dots, but we show the same ratio for each of the non-financial holdings in the portfolio. And a couple of points to draw out. Well, first of all, I should say biggest position on the left, the smallest position on the right. But then the dots show that net debt to EBITDA ratio. 2 things to point out. I said I get a bit nervous above 2. The average is 1, so pretty strong balance sheets. The red dots are more cyclical businesses that we own. And for those companies, the balance sheets are stronger still, and many of them are below 0, so net cash. And the idea there is, if we're going to take on some cyclical risk in the stock, we don't really want to double up with financial risk on the balance sheet as well. So we tend to demand stronger balance sheets for those cyclical companies. And then there's some green dots you'll see which are outliers, where high levels of gearing do exist, but they tend to be, they are utilities and concessions, where the level of debt is often dictated by the regulator in a regulated return. So we think we're not ignoring that risk, but we understand why those companies have those high levels of gearing. So we can address that balance sheet risk within, and we do address that balance sheet risk within the portfolio. And then, I guess, finally, on the market observations, a shout out for active stock picking. Everybody's moving passive and to ETFs and so on. There's still value to be had, picking stocks in sectors, and you can see a pretty homogenous sector like consumer staples, just how big the difference can be in price performance. If you pick the wrong stocks. And following on from the last slide, the thing that binds, or the last few slides, is the thing that binds those underperformers together is they've overgeared. And they've underinvested in their businesses, generally speaking. So they've normally and they've got to a position of overgearing by engaging in acquisitions. So clearly BAT, AB InBev and Kraft Heinz, big acquisitive vehicles over time, put a lot of debt on their balance sheet. The problem with that is, yourselves, if you've got a big mortgage and you lose your job, if you've got a lot of debt on your balance sheet and the fundamentals of your business deteriorate, that's not a good position to be in, and the equity market reacts to that. But if you pick the right ones, the ones that are striking the right balance of profits and reinvestment in their business and not over-gearing their balance sheet, the right kind of exposures, the right categories, clearly you can do very well. And I've got a few minutes left now for fund positioning. So when you pick up the fact sheet on the fund, you will see the typical sectors: consumer discretionary, consumer staples. I would encourage you, now I'm in front of you at least, to ignore that. And the way I think about it is very different, because within industrials you can have professional publishers, which are far from industrial businesses. Within financials you can have an exchange, which is more of an infrastructure company to me. So what I've done here is show you the portfolio as I would think of it at the moment, and divided it in kind of in the buckets I think about it in my own head. And as we go from the top of the clock, around that clock, from the most fundamental risk, putting valuation risk to one side, but I would argue probably the most fundamental risk to the most stable businesses as we go around. So you can see roughly a quarter of the portfolio is cyclical, overwhelmingly defensive feel to the portfolio. It's pretty diverse. What's perhaps noticeable are the sectors which aren't there. So we don't have much commodity exposure at all. We only have one bank. We don't have any life assurance. We don't have any real estate. And some of those are pretty traditional income sectors. So that's probably the thing to draw out there. And then In terms of geographic exposure, a lot of people panic when they look at the fund because they see the underweight to the US market. Andrew would probably say that's a good thing at the moment, but you can see it's pretty significant. By domicile, at least, a 25% underweight to the US is a proof point that we genuinely are unconstrained. But what I would say is that shows where the stocks are domiciled, not where they get their revenues from. The dark blue bars in this, the blue bars, sorry, in this analysis show where the companies we own get their revenues from, as opposed to where their head office is based. And you can see the relative exposures on that basis are much less extreme. And you end up with a portfolio which is roughly a third, a third, a third, by revenues at least, US, pan-Europe, and emerging markets, which to me feels like a nice place to be for a global strategy. The risk is pretty well balanced across the overall portfolio. We do have some stocks with below market yields. Those generally tend to be ones we bought at higher yields which have re-rated and maybe on their way out of the portfolio. And we do have some stocks on higher yields in lower growth industries perhaps, but generally speaking you can see we tend to be in this sweet spot where the yield is around 3.5%, and the prospects for dividend growth as we see them are very good. And then just in the final minute with you, a bit of a sales pitch on the fund, but performance has been good since launch. We're very happy with the performance. Worth saying here a couple of things. It hasn't been a great time for dividend investors. Time's up. Give me one more minute, I'll finish, I promise. Hasn't been a great time for dividend investors. A lot of people think, oh, it's a search for income. It's been easy to be a dividend investor. Everybody's looking for yield, but couldn't be further from the truth. And you can see that in the performance of the peer group and the MSCI High Yield Index. And this is for two reasons. One, the performance of the US market. We touched on that already. The reason that's a headwind for dividend investors is that's because it's a low yield market. And secondly, some traditional income sectors such as financials, commodities, telecoms, real estate have been quite poor performers, and it's been the higher growth sectors of the market which have been pushing the market onwards and upwards. So not a good time to be a dividend investor over the last few years. And the other thing I would say on this slide is, we don't aim to outperform every year. That's not an objective of the strategy, and there will be times when the fund lags a broader market. And you can see on this, 2017 is a case in point, a market which is very strong for a start, went up a lot, driven by tech stocks, driven by the US, and very cyclical exposures in the market. That's a very difficult environment for this strategy. We will still deliver you a good absolute return, but we're unlikely to keep up in that kind of environment. But when things get tough, 2018, 2015, the cases in point, we still, that's the kind of time we put a bit of distance between ourselves and the peer group. And you can see this on this final slide, which shows the biggest drawdown of the portfolio in the middle here versus the broader market. But perhaps more interesting in the analysis on the right there, which shows how the fund performs against benchmark in strong, moderate and falling markets. So strong markets we defined as greater than 10% return over the last 12 months, moderate between 0 and 10, and then falling obviously less than 0. And you can see the time when we really kind of earn our crust or put a bit of distance between ourselves and the peer group is when markets fall away and when volatility picks up. That's when we tend to do a lot better than the peers. Final point on the distribution to finish. I've said it already, it's a 3% yield. You can see we've grown it historically at about 5-6%. Some years better than that, some years worse than that. We see no reason why that shouldn't continue into the future. And that's a good place to finish. I still think that's an attractive proposition, a 3% real yield, if you will. There's not many other places, not many other asset classes that you can get those kind of characteristics at the moment. With that, I'll pass to Jon to talk about much more exciting stuff, and we'll come back for the Q&A. In 25 minutes or so. Thank you very much for your attention.
Thank you very much, Dan. So just to quickly introduce myself, my name's Jon Guinness, and I've worked at Fidelity for 13 years. I'm going to talk you through why I think now is a very exciting time to be investing in technology and future connectivity. But before we go into the detail about the sectors, I'd like you all to think back to some of the most iconic movies we've had over the last 20 years. And I want you to think about how things that we saw in these iconic movies that seemed fantastical in the films are now becoming a reality. So the first two here are Minority Report. That's the Tom Cruise movie. I don't know if you've seen it, but you can remember in the movie, he used his hands to manipulate electronic imagery in real time in front of him that was being projected. Now, on the right-hand side, you can see augmented reality, Microsoft HoloLens. This is a real demonstration of what it's like. This is a technology that is now real, live, and is being launched. The bottom one is the most scary. The Transformers, the movie from 2017, independent robots walking around. On the right-hand side, this is a real independent robot doing a backflip off a box. It's amazing what the robotic technology is doing these days, and I think it's quite scary for the future if this is what they can do now. The next two are Knight Rider. Everyone can remember the car kit that could talk and could drive itself. It seemed amazing at the time. Now we have Google Waymo, cars that can drive themselves without a driver, without even some of the cars here don't even have a steering wheel. And the last one is a film, more recent film, Steven Spielberg film called Ready Player One, which was a dystopian future of the globe where everyone lived on an online world called the Oasis. And late last year, Facebook launched their own version of the Oasis called the Horizon. And this is their version of an online world, they hope, where people will be able to go online, use your virtual reality headsets and interact with people all around the world. Now, why invest in future connectivity? Well, there are three reasons why I think you guys should be thinking about this. The first thing is, we believe that business and consumer activity is moving from offline to online, and now from online to mobile. This trend, we believe, is accelerating because of the amazing computing power of the cloud combined with 5G mobile connectivity. These technologies are very innovative but very disruptive, and there'll be big winners and big losers. And finally, we believe that to take advantage of these trends, you need an investment team who understand the technology, understand the financial implications, and have a deep understanding of the business innovations that are happening. So what's the opportunity? Well, technology has done very well, but this is quite an important chart. As I said, activity is moving from online to offline and offline to online and online to mobile. And we believe the trend has only just started for many areas. So here we've got online dating, food delivery, so Uber Eats, etc., ride-hailing, Uber, subscription video on demand, so that's Netflix, m-commerce, so that's Amazon, mobile gaming, and social media. The striking thing is the global penetration rates for all these things are actually extremely low. And we think that over time, all the penetration rates will shift up to the level of the smartphone penetration rate, which is around 80%. This is a fantastic chart because it shows that when the 4G iPhone was launched, in America, the amount of time people spent on mobile phones doubled. And we think that the launch of the 5G iPhone, which is, I think, happening this year, will also lead to a step up in the amount of time people spend on their mobile phones as activity shifts to mobile. Why is 5G so exciting? Well, you can see 3G speeds were very low, and we all know from our mobile phone experience. 4G speeds were good, but you can't do everything on your 4G phone. You wouldn't want to download a movie onto your 4G iPhone as you're waiting for a flight. But 5G speeds will be 10 to 20 times faster. That means that you'll be able to download a high-definition movie in around 10 seconds. And if you think about that, that is absolutely amazing. Now, bringing it together, we believe the combination of the cloud, which means you have infinite computing power, and also the combination of super fast 5G speeds on your mobile phone will be transformative and will lead to enormous disruption. What will it mean for the economy? Well, here the US Bureau of Economic Analysis on the left-hand side did some analysis of the digital economy in the United States, and they worked out that the digital economy had grown 5 percentage points faster than the rest of the economy over the last 10 years. And IHS Economics with Berkeley University and Haas Business School on the right-hand side estimated that in the year 2035, 5G will enable $12 trillion of global economic activity to be occurring. Now, that seems like an enormous number, and it is, but in 2035, that will be about 4% of GDP. So it's a big number, but it's not ridiculous. I'm going to quickly go through 3 areas that we're particularly focused on. And the way we think about businesses in these 3 segments is we think about 3 things. First is, what's the business model? Secondly, what's the technology change? And thirdly, what's the content change? And that's how we think about probably most of our investments in the fund. So the first point is gaming. And in gaming, thinking about those 3 things, there's some very exciting things happening. So the first thing is technology. What's happening to the technology? And that's the combination of the cloud and 5G. So up to now, to have very high quality gaming experiences, you had to spend $400 or $500 on an Xbox or a PlayStation, and then spend $60 up front for a game, and then probably more as you went along. What's happening now is that the technology is changing, and so the computing power is moving from your living room into the cloud, and also the very fast broadband speeds you get at home are moving to your mobile phone. That means that people will have very, very high speed, very good quality games on your mobile, which you can then cast to your television, a bit like we do with Netflix. And the business model is also changing. So instead of having to pay $60 up front, the business model is moving free to play. Now, it's not really free to play, but it means that when you start off playing a game, you don't need to pay $60 up front, and then the companies get you to pay more money in terms of buying a better gun or getting a better car, etc. But it means that you allow many more people to access your game up front who don't want to pay $400 for a console and another $50, $60 for a game. What does it mean? It means that the number of gamers globally, Ubisoft here, think will move from 2 billion people globally in 2019 to 5 billion gamers over the next 10 years. And it also means that the trend we've seen from mobile to be growing much faster than PC and console, we think this will actually accelerate. The next theme I want to talk about is advertising video on demand. Now, this takes a little bit of explanation. So you imagine at the moment you sit in your living room, you're watching normal terrestrial television, and an advert break comes on. Now, those people who are putting the advert on your television know nothing about you. They don't know whether you're male or female. They don't know whether you have a dog or a cat or no pet. They don't know whether you have a car. They don't know whether you have children. They don't know anything about you whatsoever. Advertising video on demand, think about it as Netflix with adverts. And as content moves from offline to online and then to your mobile phone, it means that they will be able to, new services which will target you, because they'll be streaming like Netflix. They'll know exactly who you are. You'll have signed up. They'll be using different data sets to know this is Jon Guinness. We know Jon Guinness lives in a house. He has a family. He has a 1-year-old. He buys lots of nappies. He has a 4-year-old who likes Lego. He has a small car. He probably needs to get a bigger car. All these things, they all know everything about me. So, and they'll know I don't have any pets. So, for example, instead of feeding me adverts about dog food or cat food or about small cars, they'll be able to Pampers will be advertising to me. And it gets even more exciting because we all know that Amazon Prime have a video service. And you can watch video on Amazon Prime. Well, it's a bit scary, but when they put adverts into that, they will be able to say, Jon has been searching on Amazon for Pampers. We are going to tell Pampers that, and we are going to get Pampers to advertise to Jon. And instead of the advert just going off into the ether, we will be able to tell Pampers that Jon has then bought nappies off Amazon. And it's called closing the loop, and it's very, very powerful. You can see on the right-hand side here, this is the advertising rate. So basically how much people pay for an advertising spot per 1,000 people watching an ad. And you can see here Hulu, it's an American service owned by Disney. The advertising rate that they are able to charge for their adverts on advertising video on demand are significantly higher than all of the traditional people like CBS and Fox and Discovery and Viacom. Because these people don't know anything about you, And these people know loads about you. And this is the difference here will increase significantly over time. And then the final area I want to talk about is digital, music, and music going digital. Now, before I talked about the business model, the content, and the business model, content, and the technology. And we own Spotify in the fund. This chart here on the left is an amazing chart. This is the history of the music industry in the United States of America. And you can see it's by method. So you can see the vinyl single. You can see the CD. You can see downloads. You can see music players. You can see downloaded albums. And you can see subscription. And you can see the music industry was absolutely decimated from 2000 onwards. We all know why. It's because of piracy and because the music album was disintermediated. People stopped buying albums and they started buying singles. And the music industry more than halved in size in the United States. Now, the difference now is that the content is the same. It's music. But the business model is changing. It's changing from downloading and buying individual singles or stealing them to having a streaming service, and the technology is changing because it's streaming music over your phone. And what does this mean? It means that people are more and more buying subscriptions from Spotify, for example, or from Apple Music, or from Amazon Music, and it's resurrecting the music industry. And this is a great example of the sort of businesses we look for, and the growth, enormous change in the growth rates over time. Now, why invest in future connectivity? Well, it's a big, broad area, so we have reduced it to 3 pillars. The first pillar is what we call the enablers, and the enablers, as you imagine, are the companies that enable these incredible networks and technologies to happen. So to use 3 examples, it's a company like Ericsson, who make the mobile base stations that you see on top of buildings and on top of mobile towers. It's companies like Intel, who make the chips that go in your computers and your mobile phones, etc. And it's also companies like Apple, who make the mobile phones that we all use. The second pillar are the network builders. And these are the companies like Telefonica, or Charter, which is a cable company in the US, or Crown Castle, which owns mobile towers. These are the networks upon which all this amazing activity happens. The final bucket is the innovators, and these are the companies that are going to do and will benefit from the amazing transformations that are occurring. The 2 examples I've got here are, say, Netflix and Google, but you can all imagine the sort of companies that I'm talking about. Now, the interesting thing about these 3 pillars is they all have very different economic characteristics. Now, this is the first pillar, and it's the enablers. And you can see here that from left to right over time, you can see the 3G, the 4G, and the 5G cycle. And this includes all of the equipment. So this is companies like Huawei, Ericsson, Nokia, Samsung, and it also includes the phone. So it's people like Samsung again, and people like Apple. And we've split it up by cycle. The really exciting thing about future connectivity is that 2019, fortunately, is right at the start of the next cycle. And we know this is very likely to happen because we've seen exactly what happened in the 3G cycle, and we've seen exactly what happened in the 4G cycle. And we believe we're at the start of a similar cycle, which will be each cycle is bigger, and this will be the biggest one yet. The next sector has very different characteristics. It's the networks. And you can see here, these are the mobile networks, these are fixed networks, these are the tower companies, and these are the global cable companies. And here you can see that the characteristics are very different. These are more steady businesses. There are pockets of high growth here. So, for example, some of the tower companies are growing fast, and some of the cable companies in the US, for example, are growing fast. But it's very different, and it's nowhere near as cyclical as the enablers. And then the final pillar are the innovators. Now, this looks like an exponential chart going from bottom left to top right, but I want to think carefully about what it actually shows. Now, at the beginning of the presentation, I said that we believe business and economic activity is moving from offline to online and from online to mobile. And this is a chart that shows this well. So, for example, let's take video streaming. There's incredible growth from companies like Netflix, companies like Disney, etc. But this is a mix effect. It's not it is growth, but it's growth for Netflix. It's taking away from companies in the UK like ITV or CBS. It's taking away from companies in Spain, the traditional broadcast companies. It's the shift of activity from offline to online and online to mobile. It's the same again for m-commerce. Now, mobile commerce is the line, because it's such a big chunk that we put it separately on the right-hand side. But here, this isn't growth on itself. This is a shift. This is a shift of people from shopping in shops to shopping online on PCs to shopping on mobile. So it's a mix effect. Digital advertising. This is again a shift from people advertising on newspapers, on traditional TV, on outdoors, and putting leaflets through your letterbox. It's a mixed shift from offline to online and online to digital and mobile advertising. And this is where the most exciting growth opportunities are. Now, why Fidelity? Well, this is the team. I have a co-manager. The team is me, Jon, and the co-manager, Sumant. We have lots of experience as analysts and portfolio managers covering the different sectors. But also I want to highlight that Sumant was responsible for designing the first graphics chip in the iPhone, which is very exciting. So he's a real technologist at heart. But we have a very big technology team. We have 20 analysts around the world. We have a big team based in London who we sit next to. We have a big team based in Japan, and we have a big team based in Asia. And we spend the entire time thinking through what are the big trends, what are the companies that we're most interested in, what are the big mix effects, thinking through the three buckets of the enablers, the networks, and the innovators, and then going into great detail about who are the winners, who are the losers, what are the valuations, and spending a lot of time with the analyst team. And my final chart is, because technology is global and because these trends are happening in all the countries, it's very important to have a global footprint. So once a year we have our TMT offsite. You can see here 2017 was in London, 2018 was in Silicon Valley, and 2019 was in Beijing. You can see a boring picture, but it's quite important. We all sit together, we'll sit around a table, and beforehand, we've worked out what are the key topics that we want to think about over the next 3 to 5 years. In blue, I've highlighted some of the areas. So, for example, even in 2017, we were thinking about the Internet of Things, about 5G, what is going to happen, who are the winners and losers, etc. And then over the year, as we get more towards the 5G launch, we've got into greater detail about different subsectors. But this really helps us think in a joined-up global way about what the technology trends are. And then I just want to highlight the bottom right. This shows the power of having a team. So this is just a couple of weeks in 2019. What were we doing? What were Sumant and I doing? Well, in the end of May, we went to New York and we met with Verizon, which is the Telefonica of the US. And we spent the entire day with the management team. We met the CEO, the CFO, the consumer head, the business head, the head of mobile, the head of fixed, the chief technology officer, talking through with them the entire day, talking through all these trends that we've just talked about. What are they doing? Who are the winners and losers? What are they thinking about 5G, etc.? And then a few weeks later, we split up. I went to Sweden, and I spent the entire day with the Ericsson management team. Again, we met the CEO, the CFO, the head of networks, the head of mobile, the head of fixed, doing deep dives into all their divisions, etc. And basically, at the same time, where was Sumant? He was in China. He was meeting with Ericsson's biggest competitor, Huawei. He met with Huawei, he met with ZTE, he met with China Mobile, he met with China Telecom. And we were texting each other. You've got to ask Ericsson this. Sumant, can you ask Huawei this question? Because Ericsson have just said that they're doing this, and I'm not sure. So it's global thinking, it's working as a team, and we think it's the only way you can invest in technology. So that's my last slide, but I just want to reiterate the message, and I guess the major point here is that we believe that activity is moving from offline to online and online to mobile. This is an enormous trend, and it's a long-duration trend. It will lead to enormous disruption, so there'll be big winners and there'll be big losers. And we believe that the best way to take advantage of all these trends is by having a deep understanding of the business models, having a deep understanding of the technology behind the business models and the changes, and also by having a global team. So that's the end of my presentation, and I hope it was helpful.
En los próximos minutos y
Over the next few minutes, and I assure you it'll just be a few minutes because I can see people getting up and leaving. I know you're all very pressed for time. So over the next just very few minutes, we will read your questions out to our guests. And I think there again you have the address to send in your questions. And I'm going to try and be really brief. If we leave any questions unanswered, we'll try and email you the answer. And I think this is going to be my last chance, or amongst my last few chances, to speak to you here, because it'll probably be a robot next time. So I'll try and do a good job.
Session with you, Andrew.
Okay.
And the question we receive is about the fiscal stimulus and monetary policy. The question is, monetary policy is reaching its limits of effectiveness as a driver for GDP. What are your thoughts about fiscal stimulus for the next years and the impact in the market, and what are your thoughts about this?
So I suppose it's again part that will be a very important conversation for this year. To your point, that there's a perception of limits, but not that we've reached the limit in monetary policy, as you saw in the impact of the easing last year. But it really is, where is the scope to do that? In the US, as I've argued, that actually there's very little chance of that now. The reality is what happens post the election. So that switchover is not occurring. And in reality, we already have significant fiscal policy easing has occurred within the Trump administration. And we've seen the benefits, and that's actually easing off. In Europe, I should most probably ask many of you that what the thoughts are for the ability to follow through on elements of the Green Deal and for broader fiscal moves. The constraints are there, but there will be some easing. The German rail deal announced yesterday is just signs that there will be that move. And then around the world, I think there's more scope. So back to why looking to some of Asia, to some of the developing markets generally, they have more opportunities to use fiscal levers with the monetary policy easing, and why we think that the degrees of growth rates and opportunity are going to be seen there. The impact, I think, that have to be careful of is that if there is some sense of fiscal policy really starting to ease, is that yields will start to rise relatively rapidly as a risk. And that changes the whole game, because then you're talking about changing yield curves and the change in the discounted cash flow pricing of so much of the long duration profile we trade today. So I think the fiscal policy will move a bit, but not significantly, and it will move more in some of the developing markets than the developed, and the impact, though, marginally moving in any of the developed markets will have a bigger impact onto their yield curves and onto long yields.
John, let's talk about the 5G race and in the supremacy for 5G technology or race. Who will win the battle? US versus China, and which could be the role for Europe?
So it's a great question, and it's very timely, given that Trump is obsessed with Huawei and the security implications of Huawei. So very clearly, China is the winner. And so they have a top-down approach. They basically have told all their China Mobile and China Unicom and China Telecom that they have to invest in 5G. Huawei have been very much ahead of the curve in investing. The government has made available an enormous amount of the right type of spectrum to their mobile companies. And to put it in perspective, China have invested in over 1.5 million base stations for 5G already. We had a data point last year, which was in June. The data point we had was that about 8 or 9 million Chinese people had signed up for 5G services, and that number now will be way ahead. The US is a different case. So the government is very focused on 5G and getting ahead of 5G. The Department of Defense has written some very interesting white papers on the importance of being ahead in 5G. So they see it as a national security issue, which is clear from Trump's behavior. But there are a couple of issues. Firstly, they don't have the right spectrum available now. So they have spectrum which is okay for 5G, but doesn't send the signal far enough, which means that their 5G will be slightly different than the Chinese 5G and slightly worse. And the second thing is that because they have this Sprint T-Mobile merger happening or not happening, we'll find out very, very soon, lots of the telecom companies have put some investment on hold, as you imagine they would, meaning that even though Verizon and AT&T and T-Mobile talk about 5G, they have not invested nearly as much as the Chinese have. And then the last part of the question was Europe. And unfortunately in Europe, we're even further behind because the European Union has, rightly or wrongly, focused on competition and pricing over investment in Europe, in every country in Europe. So we have a very, very cheap mobile services relative to, say, Japan, relative to the US. In the US, you'd pay 50, 75, 100 euros equivalent for services that we pay 20 euros for. But it means that the returns in Europe for mobile are much, much lower. There's a much lower incentive for them to invest in 5G. And we're only very slowly seeing Telefonica and Vodafone and Orange and Deutsche Telekom investing in 5G services. So in order, I would put China ahead, clearly ahead, then the US, and then Europe slowly running up the rear.
Dan, with attractive valuation, good quality business, and even quality income, do you think that 2020 and the next year will be the comeback decade for UK business or UK companies?
The UK companies? Oh, that's a good question. We were drawn to UK companies throughout the course of last year to look at some of them, given a kind of contrarian slant that we have to our investment style. Clearly, as we approached Brexit and then the elections, they were very much out of favour. It's difficult finding the kinds of companies we like to invest in the UK. There are a few that we've looked at. But in terms of UK domestic businesses, there's not a lot that we see as particularly attractive. So it's not somewhere which I've if you look at the fact sheet, and I made this point in the presentation. If you look at the fact sheet, it says we've got 15% in the UK, but the vast majority of that exposure are multinational businesses. I mean, Unilever is one of them, for example, which is a relatively big position for us. It's a UK company, but the reality is 60% of its revenues come from emerging markets, so it's far from a UK business. Most of that UK exposure you see on the fact sheet is actually multinational companies. There's not a lot in the fund which is UK domestic, and there's not a huge amount on my kind of subs bench or watch list either, which is UK domestic. A final problem I would say in the UK market is the commitment to progressive dividend policies over the years has pushed many companies to a point where now they are over-distributing. Mm-hmm. So a lot of the yield in the UK market comes from the big 5 or 6 companies, and many of those companies don't cover their dividend, quite frankly. So Glaxo hasn't covered its dividend for many years. Vodafone didn't, and it's now cut. Royal Dutch Shell issued scrip for a while, so there's, the miners have cut, so there's risk to dividends in the UK as well. The headline yield is pretty attractive on the UK market, but it's for a reason. It's because the dividends are under threat for a lot of those big stocks.
Yeah. Andrew, question about ESG, probably expected. The rise of sustainable or socially responsible investing has been one of the major trends in the last decade. Which is Fidelity, or which are the Fidelity commitment in this area?
So it's very significant. I suppose one way to reflect that is that I don't know how many of the audience know today, but during the last year that we now have moved to have ESG ratings in all the companies. that we analyse. So, as John and Dan have highlighted in terms of the analysis and the depth that we look at individual companies for their portfolios, that now across the whole of our range, which is looking at debt, at equity, and also putting ESG ratings onto those companies. So I think the commitment is significant. I also think that in where we are today, as an industry and providing for investors, then it's quite a significant leap forward, mainly because I think that it's still, for many investors, thinking about, are you looking at an exclusion policy? Are you looking at an impact and trying to influence policy? And where you position yourselves, we can actually provide the underlying ratings profile, which actually is a very much forward-looking profile for the companies, not backward-looking, but forward-looking. So you can start to think about what individual exposures you'd want in portfolios and how you build portfolios. So I think it's something that, in this last year, if I'm honest, most probably Fidelity was in the pack and not necessarily near the top. I think where we are today is actually quite a significant leap forward. And actually, from an investor point of view, I'd like to believe that we can help you think about what those individual constituents could be within portfolios that really meet what you're trying to achieve for your investors and for the types of ESG-linked outcomes you need.
John, you mentioned some companies in the advertising, gaming, social media companies that they look very beneficiaries about the 5G. But what about the other side? What about the communication equipment? What about the infrastructure? How these companies in this area could monetize the 5G technology? Because it's a huge investment in this infrastructure.
Absolutely. So so we own Ericsson in the fund, which is a Swedish maker of base stations and equipment for mobile and 5G, and they've been a big beneficiary. They've been an extra beneficiary for two other reasons. Firstly is because Huawei have either had a hard ban or a soft ban, basically in Japan, in Korea, in the US for a long time, but also now in Europe. Whether the governments say no Huawei, or whether the governments behind the scenes call up the CEO of Telefonica and say, actually, probably better not to have any Huawei equipment. There's a soft ban or a hard ban for most Western countries for Huawei equipment. The way to think about it as well is if you're a chief technology officer thinking, what technology am I going to put into my network for the next 10 years, do you really want to risk Huawei or ZTE? And maybe you're not being hard banned now, but maybe in 3 years' time, the US government says actually no Huawei equipment. So it's pretty clear that when you speak to the companies, they're not going to put in any Huawei equipment from now on, and they're increasingly thinking about ripping out the old Huawei equipment. And then the final one is Nokia, which has been a huge loser. Now is the time for them to do well, but they merged with Alcatel-Lucent. They made some enormous technology mistakes with the chips they're using to put in their base stations. They can't deliver 5G base stations to any of their customers, really, unless it's at a great expense using a strange technology cheat. However, I would say that we have a bench, like Dan said, and Nokia, we met again with them last week. Nokia's on our bench, and we can't quite believe that they wouldn't also be a winner in the 5G world, given that people can't buy a Huawei equipment. So it's a company we're thinking about all the time. It's probably down 70 or 80% over 5 years, but it's one that we're thinking about very hard. We're doing a lot of work on. We're meeting them very regularly, and again, it's one of our bench stocks that we think, goodness me, if Nokia can't do well in the start of the 5G cycle, then they're never going to do well. So it's one that we're thinking about hard.
In order to respect the agenda, I think we have time for the last question. And it's an open question for any of you. And it's a question about the repo market. At the end of the last year, the Fed started expanding its balance sheet again, address the tension in the repo markets. Do you think that we will continue to see these kind of episodes and the impact in the market?
Do you want me to take that?
Yeah.
Yep.
So you, Andrew.
I think it's a case that they have to. So I think the discussion that you've seen from some of the Fed governors in the last few days is, should they be rolling back some of that balance sheet build out? But it doesn't mean that they will stop. It's just that it's not at 60 billion if it is a lower number. I think it's important that, going back to the thoughts around the US, that it needs stimulus to stay where it is. So the Fed taking this back at this stage, could have very negative repercussions, and I don't think they're willing to take that risk. Secondly, that there was a confluence of events in Q3 last year, which was basically the US Treasury rebuilding their balances, having lowered them before a debt ceiling increase, that you had enormous August refunding issuance. So as I said, the US Treasury and as the country as a whole is issuing enormous debts, and that was a peak point there. It actually stopped the corporate bond market issuing for a while. There was actually crowding out for the first time, I can remember a long time there. So the Federal Reserve has to keep that sort of liquidity into to the system. So I don't think they can withdraw entirely. But I think the conversation will be, do they pull some of that back in terms of the amount that they've been doing as a sign of confidence? The other part from this to remember is that they are focusing on T-bills. So the function, as I was saying earlier on, is if you start to see any broader conversation around either inflation as a late cycle impact, or even there is growth slightly higher than I've been discussing, or uncertainty building around fiscal policy going forward because of possible change in the administration. The risk is the curve will start to steepen because that short end is anchored by this constant buy-in of T-bills, and I don't think they'll extend in terms of securities they buy.
Gracias, Domingo. Con este...
Thank you, Domingo. With this Q&A session, we put an end to today's session. I would like to thank our three speakers for having joined us this morning. Thank you, Andrew, John, and Dan, for your wonderful presentations.
To you, except in your case, Dan, in which you actually ran over and you got caught. Las presentaciones serán
The presentations will be sent to your email addresses today. Thank you very much for sharing them with us, and they will also be available on our website, fondesfidelity.es, and you can personalize your accounts to receive the contents you are most interested in. And please don't forget to fill out our feedback form. It is very useful for us to keep improving the quality of these events. Thank you again for having joined us this morning, and I hope to see you very soon.